Welcome back. If you just heard the Central Bank Governor Godwin Emefiele giving his announcement on the MPC, surprising 150 basis point rate hike here in Nigeria. It also increased the cash reserve ratio by 5%. Quite a lot to digest, but I'll just read 5 key sentences from his comments there. Governor Emefiele says, we have no choice but to raise rates. This aggressive decision must yield results. We must mop up liquidity effectively out of the vaults of banks, and we should see inflation decelerate. Liquidity extraction will constrain speculative use of funds. Tilewa, let me get your first reactions.
Well, I wasn't quite surprised with the rate hike at about 150 basis points. I think considering the issues of inflation at runaway levels, that wasn't too much of a surprise. I think what actually took me by surprise was the cash reserve ratio, which went from 27.5 to 32.5. Considering the fact that you have over 50 trillion in deposits now, 30% of that 50 trillion is close to about 17 trillion, 32.5, 17 trillion that's going to be mopped up. And don't forget that in April, 10 banks were debited 7.2 trillion to be able to meet up with their cash reserve requirements. So the big elephant in the room is that while you might be sterilizing with cash reserve requirements and some special notes, we still have the ways and means financing of 25 trillion out there or more. So it seems to me that while you're taking this money out from the banking system, you're pushing it out through to government by ways and means. And I think that is really what is driving inflation. Because in Nigeria, our inflation is not on aggregate demand. Most of our inflation, and even the inflation now, is what you will look at as cost push. The central bank governor also mentioned the issue of energy prices with diesel, food inflation. Those are the key drivers of inflation. When you add the ways and means financing to this, then you can begin to see the triggers of runaway inflation. So it's important that they address this issue of the ways and means financing, currently at close to 25 trillion. And let's ensure that the CRR debits are not being used to finance the ways and means. Otherwise, the net gain will be zero.
Quite a lot said there, but Lawrence, let me get your first reaction as well, and more or less the implications for banks on that CRR increase by 5%.
Yeah, certainly a lot more aggressive than we were expecting. On the interest rate side, I think the MPR still, it's a policy tool that the transmission mechanism is not yet fully orthodox, and the feed through is not as well transmitted as in other economies. But I think the CRR certainly, I think, like I mentioned before, the MPC, I think there's still a lot of liquidity in the system, and we see that through asset prices, which are quite inflated. If you look at OMO and T-bill yields are still single digits. So the spread between kind of local currency assets and dollar instruments is tightening quite a bit. So I think this will go a long way towards starting to make asset prices more attractive. I think there's definitely an implication for banks in the sense that it's a huge amount of liquidity that has to flow out. I think we'll probably see the short end of the curve aggressively kick higher. The one thing that I found interesting is that for a central bank that's been quite fixated on NAFEX and FX rates, they didn't really make any mention of that throughout the MPC statement. So it speaks to, I think, the fact that they're looking towards to move in time towards a more orthodox monetary policy through MPR rate, etc. Which was the focus. They were really focused on the rate side of the equation and didn't make a lot of mention on the FX side. So that was just interesting. I think the tightening of liquidity definitely speaks to the fact that they're looking to take speculative demand out the market, and that should potentially weigh on the spread between official rates and parallel market.
Okay.
So interesting, I think.
All right, talking about that spread more or less. I'd like you to speak more or less on what we saw. Yes, the hike has been made, but then we still have that significant distance between the MPR and inflation. Inflation at 20.7%, 20.5% for August, and MPR now at 15.5%.
Yes, but with inflation at 20.5%, it's very difficult to move that rate from 14 above 20% to be able to make real rates positive. That would be the ideal situation. But that kind of hike will cause a very significant shock to the system. But I think let's talk about what Lawrence has said, in the sense that we haven't addressed the issue of the foreign exchange. There's now a 65% spread between the official rate and the parallel market rate. And that is as a result of multiplicity of windows that the central bank has. If you're trying to control that, as he said, that you don't want excess liquidity to be chasing foreign exchange, what are the alternative in investment assets? It's talked about the OMO yields and the T-bill yields not being competitive for investment purposes or returning negative yields in essence. So in terms of investment class, investors are not finding anywhere to put their funds. And the interest rates the banks are offering on your deposits is way below the level of inflation. So the challenge we have when you have stagflation is the fact that you need to make some radical moves. And unfortunately, like I've said earlier, the big elephant in the room is the ways and means financing and the fiscal issues we have in Nigeria today. Revenue cannot even service debt repayments. You're increasing interest rates. The impact on that is that the federal government debt payment is going to go higher by another 150 basis points. So debt servicing is going to become more expensive for the government. But again, central bank is going to go back to its fallback position of trying to maintain financial stability and raise rates. So orthodox move, but the issues in the foreign exchange market with the 65% differential, and of course the ways and means financing, needs to be addressed.
Yes, definitely quite a lot for the central bank to address. But Lawrence, looking at what the central bank governor said, more or less asserting that we must see this action more or less yield results. You earlier called for about 100 basis points. This was a bit much higher than you anticipated. But then, do you think we could see this yield the results that we so desire?
Yeah, I think it will take some time to feed through. But I agree. I think the larger issues are on the debt side. I think the issue is rates are going up. It hasn't been addressed. So, I mean, they can continue issuing to service debt cost, debt servicing and kind of running costs of the government. But the higher the yields go, the more unsustainable debt becomes over a long term. They are in a position where debt to GDP is still at fairly low levels. But again, I mean, increasing the problem over the long term is what we've seen some of the other regional counterparts do the same, and now they've run into real debt sustainability issues with the IMF having to come and basically bail them out. So, and there's talks of restructuring across multiple countries in Africa, and I think if they don't address the real issues, as has been touched on quite a bit, I think the problem will just be a long-term problem, and eventually it will cause them much more harm than the short-term implications. Again, I think the government also touched on the INE window, and it's not the responsibility of the central bank to fill FX for normal business operations of certain industries. Now, it's fine to say the INE window, but I mean, if that level isn't conducive of actual value, I mean, you're not going to see the inflows to fill that demand. So various things that still need to play out over time. But definitely, it's very aggressive.
All right. Another major point that came out of the conversation as well was the amount of inflation, the amount we've seen inflation increase in the past 4 months in Nigeria, more or less. And he's talking about more or less trying to see that reduce or decelerate before Christmas time. Do you think that could be possible here?
Yes, it's possible, and I think that's why you see the aggressive move with the CRR. And I think he's made a very clear statement. There was a 7.2 trillion naira debit in April to the banks that did not meet that requirements at 27.5%. Now it's 32.5%. That's the CRR. So you're looking at 32.5% over close to 55 trillion deposits in the system. So that's pretty significant. So he's going to go after those funds, and he's told them that by Thursday, I mean, you heard what he said. So he's giving them till Thursday a deadline that those debits will be in there. So it's something that you're going to see an immediate impact before the end of this week. And I think he means that business because he wants to slow down that money supply. He wants to remove that liquidity from the system, and he wants to stop that speculation against the Naira. So his trick to address the 65% differential between the parallel market and the official market is to squeeze out the liquidity.
Squeezing out liquidity. But then, talking about banks being precluded from the FX market, I'd like to get your thoughts on this as you wrap up for this session. Lawrence?
Sure. Look, I think, maybe just to touch on the spread again. I think the liquidity will definitely work to reduce that spread. I think a lot of the inflationary pressure has come from the parallel market rate, because that's ultimately the market where business is going through. I think banks being precluded from the FX market, they're not necessarily precluded. I just think they're limited in the amount of supply. I think there's various initiatives that the governor touched on that's been put in place that will yield results over the longer term for export proceeds. But I think if you look at certainly oil revenues haven't really produced any proceeds given oil production issues, and also the fact that subsidies swallow up a lot of that. So they really look to non-oil sectors providing that. So over the long term, I think it's probably going to start yielding results. But in the short term, I think the immediate inflows typically would be from portfolio flows. But given the global pressure on all markets and really investors bringing the dollars home as such, it's a tough equation to solve in the short term.
All right, quite a lot there. Thank you so much. Any final words, Tilo, as we wrap up the segment?
Well, I think we've said it all. I think it's a brave move, very good, a very aggressive move in terms of increasing interest rates. But the challenges are still there, and we just hope that we can begin to see the effects in the next 3 months.